Russia's central bank has cut its key interest rate despite rising inflation and new Western sanctions. Governor Elvira Nabiullina says the move aims to support the economy, but the outlook remains uncertain. On Friday, the Russian central bank lowered its key rate to 16.5%, signaling a continuation of monetary easing despite persistent inflation pressures. The bank revised its key rate forecast to 13% and 15% until next year. That is despite predicting inflationary risks, including higher fuel prices, rising taxes and increased utility tariffs.
Today, we have made the decision to cut the key rate to 16.5% per annum. The situation has been developing generally in line with our forecast. Monetary conditions remain tight, fostering disinflation. Therefore, we have made the decision to continue monetary policy easing. At the same time, significant pro-inflationary risks have materialized.
Economic growth projections were also lowered. GDP growth for 2025 is now expected between 0.5% and 1%, down from the earlier 1 to 2% forecast. Meanwhile, inflation is predicted to reach 4 and 5% next year, with the central bank betting inflation to return to its 4% target only in the second half of 2026. Governor Nabiullina highlighted persistent risks from lower global oil prices and sanctions, noting that Russia's economic outlook depends heavily on how the country adapts to these challenges. She stressed that while sanctions are a negative factor, immediate changes to monetary policies are not yet necessary.
Last year's strong economic overheating gradually subsides. This is happening due to more moderate demand dynamics as compared to 2024, coupled with an ongoing expansion of companies' production capacities. However, certain indicators show that this process still remains unfinished, particularly the indicators of labor market tightness, including historically low unemployment levels and growth of wages outpacing that of labor productivity. Nevertheless, we are registering some signs of an easing in the labor market.
The ruble has strengthened by about 10% compared to the 2024 average, but slowing growth, higher price pressures and easing rates weigh on the outlook for Russian markets.
The sanctions are aimed primarily at restricting the export of our raw materials. It's unlikely anyone can accurately predict the impact of these sanctions. We view this as a negative external factor. Much will depend on how we adapt to these sanctions. We know from previous periods that this takes time, but adaptation has occurred. Therefore, it isn't necessary yet to assess whether this will require any changes in monetary policy decisions. We will see how the situation develops.